Okay, I think we're all accounted for at this point, so that's excellent. We will go ahead and get started. I'll call this meeting with State of Michigan Investment Board on September 22nd to order. Janet, would you please call the roll?
Absolutely. Good morning. Chairman Treasurer Rachel Eubank.
Present.
Thank you. Ms. Dina Richard.
Present.
Thank you. Mr. Reggie Sanders.
Present.
Good morning. Mr. Chris Parkins.
Present.
Thank you. We have quorum.
Excellent. Okay, so we've got a normal agenda today. We do have two guest speakers today from ANN, so looking forward to hearing from them. We have one, our first voting item on the agenda is the approval of the June 23rd Senate meeting minutes. Is there a motion to approve those meeting minutes as presented? Motion?
Yeah.
Thank you, Mr. Sanders, support. All those in favor signify by saying aye. Aye. Any opposed? All right, meeting minutes are approved. And so we are right on schedule, Mr. Brett, to head on over to your report. Hey, I mean, if we can get through a roll call and the minutes in 10 minutes, we are good to go. We're good to go. So yeah, first item is the executive summary performance from the mid-period.
Thank you, Treasurer. I guess first, before diving into the executive summary, we have a new face at the table, Lam Chen, who has been selected for our new head of our trust and agency divisions, which helps oversee 401k, which gets into the quarterly report, but also different state funds that are the state treasurer is a sole fiduciary over various state funds like DNR Natural Resource Trust Fund, Children's Trust Fund, etc. There's a whole host of them. And so her unit does asset allocations for those funds and helps invest, leveraging off the other staff in this room, the public and private market. So would he retire? Kind of. He did retire officially from it, and he's now interim at the police and fire for Detroit. So, and who knows? So he's off. He had been on that board for quite a while. So he stepped off the board. Is now the interim seat. Had to go down there. And Lam, we'll just. You want to say a few words of your background? Or?
It's a pleasure to meet you. Yeah, my name's Lam Chen. I started my career at Salomon Brothers and then was recruited by a former colleague at Salomon to join Deloitte Consulting, so did that for a few years. Then got my MBA, and then we had a baby, which was wonderful. And so I took some time off from my career and raised our children, and then came back and have been with the Bureau for about 8 years, a little over 8 years, working closely with Woody on, as Sean mentioned, fund contributions as well as trust agencies. So I'm excited to move forward in this role.
I would just add that, I mean, Dawn, has built her own great relationships with the many boards and commissions of which the Bureau of Investment serves and which she's been the point of contact. And I know they're all thrilled to have her stepping into this role too. So while you never replace somebody as special as Woody, I'm so excited for what Mom's going to bring to this role. Thank you. Congrats and welcome. Thank you.
And I think in terms of EOI, I think the treasurer probably knows Lon just because the treasurer sits on so many boards and agencies, and Lon presents is the point person. So here I'm kind of the point person just by the nature of the position, but she's kind of the point person on all these trusted. So welcome, congratulations. We're happy for you. Very excited. So diving into the executive summary, the returns and long-term focus, the 10-year returns 10.3 versus peers of 8.4. It's pretty interesting how consistent these returns are. It isn't always that way, but the 5 years is 10.3 versus peers of 7.9. And the 3-year return is 10.6 versus 8.2. And then with the challenging markets, our 1 year 1.3, most peer plans are down negative, close to 3%. So we have a lot of private markets. So hence, any plan that had a lot of private markets outperformed during this time period. And that's why we outperform. Going forward, I'm sure we'll take some marks on private markets as well for September 30th plan. So, but anyways, great returns for these time periods. And the last bullet point there, right above asset allocation, says, compounding over a long period of time can add a lot of excess value, which is on top of what peers have earned, peer median. So that turned out to be about 21 plus billion over the last 10 years. We do have a lot of equities. Some of our equities, a decade ago, we decided to build out absolute return. And the goal there was to have bond-like volatility, kind of an engineered portfolio where it's bond-like volatility, but better than bond returns. And a few pages over, if you look at the 10-year bond return, you just look at performance tab briefly. And it shows returns for each asset class. But fixed income for 10 years was 2.9, which was better than the benchmark, but it was 2.9, and rates were really low. Absolute return, you can see right below, is 6.2%. So that was a good trade over a 10-year period. And so we still have that on. I don't know if it's a trade, it's more of an asset allocation, strategic allocation, but that's what we did 10 years ago, worked into it, and that worked for us. So that's another reason for outperformance. We made that trade and we brought bonds down. That would be the right answer over a long period of time. And I'd like to thank staff for the returns. Each asset class has performed really well. And they've, again, a lot of people like asset heads, Jim and Greg, head of public and private markets, respectively. There's a lot of due diligence in each of these areas, a lot of great managers we've picked, a lot of long-time managers. I was speaking to a head of another pension fund recently, and he was complaining about their private equity portfolio. It's just not on par. The recent CIO there, maybe 4 years. It's hard to change a private equity portfolio very fast. We don't have that. So I felt really good. Talking to another CIO, and a lot of times, Wall Street likes to sell you things, and they were getting into different credit. And they'll come in and talk about their past returns and how they have a great strategy going forward, but nobody really knew what they owned underneath what the actual investments were. So once the CIO started asking questions like, what do you actually own? They found out they owned some pretty esoteric things, things they didn't want to own. And so I think our staff does a good job of getting into the weeds, figuring out what do we actually own, and not just look at these strategies, but it's like, what's the underlying holding? That's really important risk mitigator. So thanks to staff. I think today we're going to talk about asset allocation. We do this I wanted to say a few words. We do this about every 2 years. Asset liability studies, a lot of times for other funds, are done 3 to 5 years. We do it every 2. It allows us to change our allocation incrementally. I don't think I'll wait 5 years and then really switch a target dramatically in one asset class or another. I kind of want to do that as we go. I think if you take a real high-level snapshot over the next, I know this is long term, so it's almost nonsensical, over the next 15 years of the fund, it's long term for any of us here, but in terms of a defined benefit plan, it might not be that long, which is kind of crazy to think about. But in 15 years, there'll be a lot more demands of liquidity. Our net outflows on the plans will be heavier. So kind of every 2 years, you'll see that we've increased fixed income a little bit over the next 2 years. And I think you'll see liquidity go up over the next 15 years, call it. So we can be in a position to pay benefits, which is one of our goals around here. One of our chief goal really is to pay benefits. So that's my executive summary. I'll turn it over to Greg for asset allocation.
Okay, thanks, John. Lori, can you turn to page said it was 16. It's the first page for the folks here in the room. It's the first page under the asset allocation tab. So just a few words on the current state of asset allocation. The bottom left table, I think, is helpful to understand where the capital is allocated at the end of June 2022. To John's earlier point, heavily invested in equities. And again, the reason why we have a risk posture is because we have a hurdle rate that's higher, much higher than risk. I'd like to look at comparison from year to year. So we have also our asset allocation June 2021. And again, you can see some changes in the asset allocation over the year. And those changes really come about for two ways. One, return differences in returns for the various asset classes. And two, movements, capital flows in and out of various asset classes. So turning to page 2 under the asset allocation tab, I'll speak a little bit more to those movements in capital. The way you read this chart, the bars go up, that creates cash. The bars go down, that uses cash. So the bar all the way to the right, those net benefit payments that John spoke about earlier, the fund paid out, the funds collectively paid out $1.5 billion in the past 12 months. So how did we pay for those benefits? That little table to the top right corner, we used about $1 billion in short-term fixed income to pay for those benefits over the past 12 months, and the rest came from the asset flows through the asset allocation. I'd like to just point out a few technicalities on this specific chart. John earlier mentioned that absolute return portfolio that we created 10 years ago. It's still a work in process and progress. And so what we did over the past 12 months was really allocate some of the investments that were in other asset classes to be accounted for in the absolute return. Right? So they were better fits, better homes for the absolute return portfolio. There were no changes to the investments, but we just housed them more appropriately in the absolute return. So approximately half of those flows into the absolute return over the past 12 months were these reallocations from the private equity portfolio in the real return opportunistic portfolio. The other bars, if you will, were real cash flows. So we moved $1 billion, for example, out of domestic equity in the past 12 months. We moved $940-some million into real estate infrastructure for the last 12 months. The last points I'll make on the asset allocations on page 3 under the asset allocation tab. This is the current strategic target in our current allocations to the various asset classes. Private equity is over the target of 16% by a little over 9%. Domestic equity is under the target by about 6%. Everything else is plus or minus a percent or two, right? So it's very difficult to dial in precisely from period to period the asset allocation. So these are our targets. And so a percent or two, we would consider at target. As you can see, the over allocation to private equity, there's some great news there. We got there because we had fantastic investment returns. And to John's earlier point, it's difficult to make changes in the more illiquid private markets. And so over time, as distributions pick up even more materially there, we would see that asset class trend back towards target and offer us opportunities to rebalance some of that excess capital to the other asset classes. That's all I had on the current asset allocation. If there's any questions, to Jason Treasurer.
Yeah, I have just one question and just a thought on, John, you mentioned in your comments the strategic decision, less fixed income, more absolute return. And as you think about that, Greg, and thinking about your outlook, does that change with interest rates moving up?
Well, it's a great question, and it's a lot harder question than it was 10 years ago. A lot of our absolute return, big portion of that portfolio is private credit. So, and you're still earning anywhere from 7 to 9, depending on what type of private credit. If it's senior lending, and a lot of it's floating rate loans. So we like that idea because it's floating rate. As interest rates go up, we've seen what's happened to fixed income values. They go the opposite direction. They go down. So we probably still going to keep it on, but and another factor, this is a long-term allocation, so that's a big consideration. If you look at the current market, you can get some, in public fixed income, some pretty competitive yields now that rates have went up. The 10-year is at 3.5%. Shorter terms higher, but 10 years at 3.5%, and you had some credit spread, and been spending a lot of time on phone calls like with PIMCO and on core bond funds where I wanted to have, I've spent more time on core bond funds in the last 6 months with Dan and others than I have, in the previous 6 years. And the yields are getting pretty, attractive. So yeah, the gap has narrowed incrementally, and, we're going to add to fixed income as a recommendation today. And because the private markets are illiquid, we don't want to sell them at a discount or anything like that. So I still want to keep it on, I think, in the absolute return because of the spreads and because of the floating rate. But it's a good question. And the question is, the economy's kind of blinking. Inverted yield curve usually leads to a recession. Who knows if that will happen? Who knows how severe a recession would be? But if that happens, in my mind, do rates, if the Fed gets what it wants, do rates come back down? Because long-term demographics are still, slow growing for the U.S. over a long period of time. So I think, this upward rate movement, I wonder how long it will last. Will it be a year, 2, or 3? Will it revert? So, but I'm still comfortable with the absolute returns.
Question. Did you want to do your market review and outlook, or?
I'd like to save that time for the
Sure. Well, then why don't you go ahead and introduce our speakers?
Okay, yeah, so as John alluded to earlier, we, your investments, have spent the past 6 months working with Aon to conduct this asset liability study today, leading to the recommendation for change in our strategic asset allocation. Our primary source of contact with Aon is Max Corey, and so I'll let Max introduce himself in the Aon team.
Thank you, Greg. Yeah, I thought I should probably quickly introduce myself. So you may just know me as the guy lurking in the background. But I am the actually primary contacts at Aon. So it's me, Aaron Knapp, Steve Cummings, who you met before he was going to be here today. That's his main trouble. So his face, I think, is this screen. But we are the primary contacts. We assist Bureau of Investments with various projects relating to the investment program. The big one, as Greg mentioned, over the last 6 months, we began to study and we pull in resources from the broader Aon to help with that. The two main ones for that project are at the end of the table here, and I'll let them introduce themselves in a moment. But we have an AL team that analyzes the liabilities of our clients' retirement systems, and they use that to help inform the optimal level of risk to take from the assets. And the derivative of that is sort of the optimal asset allocation, sort of how best to take that risk. So with that, let me hand it over to Phil Marcus and John Sullivan to introduce themselves. I'll just mention briefly they are part of, again, investment policy services team. Phil heads that team, and John. maybe Phil, that over to you.
Thanks. Hi, everyone. It's nice to be with you again. I'm Phil DeMarcus. I'm the U.S. Director of Investment Policy Services with Aon. I've been with the firm for 28 years, spent the first half of my career as a pension actuary, before moving over to the investment practice to assume my current role. Been fully credentialed actuary and an investment consultant, so a fellow of the Society of Actuaries and a CFA charter holder as well. And the team that I lead, of which John's a part, conducts hundreds of asset liability studies like this for a variety of pension funds. And the goal of these types of exercises is to use quantitative analysis to support investment strategy recommendations. So that's what we'll be doing today.
John. Good morning, everyone. John Sullivan from Aon. As Phil mentioned, I'm a part of the Investment Policy Services team. About 20 years of experience in the consulting field, similar to what Phil said, first half in the actuarial side, back half in the investment side. My particular emphasis on our team is public sector asset liability studies, and this is a couple times we've gone through the Michigan study, so interested to share the results and entertain any sort of discussion that comes.
All right, fantastic. So I think what I'd like to do, if I may, is walk through the kind of the start of the presentation. John is going to walk us through some of the technicals. He crunched the analysis and is the foremost in this regard. But I'm going to walk through, just for starters, the table of contents, and just to say it, John and Greg have prefaced it well. We're going to examine the investments within the context of the pension. And so that's everything we'll be looking at. We'll start with an executive summary. That'll be the bottom line on top. Here's what we found from our analysis. Then we'll dive into the analysis. We plan to spend about 30 minutes walking through the highlights of the analysis rather than every number. We literally crunched what amounts to millions of numbers when we produce this analysis, but we're just going to give you the highlights rather than diving into every one of those million numbers. So the analysis will start with the current state of the plan and then move into portfolio analysis. We'll look at our projection analysis and also net outflow analysis, because that has implications for the liquidity of the fund. And then where we start with the bottom line on top, we'll conclude with the bottom line on bottom to reiterate the points that we made. Any questions before we dive in? All right, then, if I may take us to page 4. The overview of the asset liability studies. This is really the what, why, when, and how. Why do we conduct these asset liability studies? So an asset liability study is intended to be a toolkit that you can use for decision-making on the investment strategy. So everything we're going to examine will be with an eye towards, and what does this mean for the investment strategy? Why? Because the assets and liabilities should be related. Think about the funding of the plan. What you ultimately want is you want sufficient assets to pay out your obligations. And so it's important to examine how the assets perform in light of the liabilities. I think John mentioned it earlier. Our typical clients conduct these studies every 3 to 5 years. The state of Michigan is on top of it every 2 years, examining the strategy, which is healthy. And then what are we doing? We're examining future trend lines. So, for example, the funding ratio of the plan today, well, how is that projected to grow over time? And what does that mean? What does it mean if the trend lines are pointing towards a fully funded plan or pointing lower? And so, it's important to understand how the projected trend lines look so that you can make an informed decision based on projections. Next slide. There are really 3 things that we examined in detail. So, millions of numbers, as I mentioned, but what are the 3 key things that we examined? First, and perhaps foremost, what's the mix? What's the right mix of return-seeking assets versus risk-reducing or safety assets? And as you'll see, we've categorized it as 87.5% return-seeking in the current portfolio. And the first and foremost question will be, is 87.5% the ideal percentage allocation towards return-seeking assets? Second, we examined the liquidity of the fund. We recognize that the net outflows of the fund might increase over time. And so what's the implication to the liquidity of the fund? And third, we examined some of the funding interactions. Your funding policy is unique. And so we want to examine how that looks. So we'll have some discussion on that as well. All right, so those are the three key things. Now the next slide is kind of our bottom line on top of what we see. And generally, in terms of the mix of return-seeking versus risk-reducing assets, we start with, well, the plan's underfunded today, but we think the portfolio is well constructed. And it has a high likelihood of achieving the actuarial assumed rate of return of 6% by and large. But examining those trend lines, those future trend lines, we see that the plan is expected to get to full funding by about 2031, so in 9 years' time, which, by the way, is sooner than most. And then thereafter is projected to go into a fully funded state and then some. And so the question then might be, well, does it make sense to start to pare back a little bit so as to not overshoot the mark and take risks to get there? So we'll examine that. On the liquidity front, we'll examine the net outflows. We've projected out the net outflows. Those are expected to increase over time. And as a result, it might make sense to increase the liquidity of the fund. And then third, your funding policy provides some buffers. These buffers are nice to have in terms of it's a conservative policy. It allows for some buffer on the downside. So we'll examine what that looks like. All right, so that's where we're headed. That's very high level. Now, to dive into a little bit more detail with some key observations. With the current state, I mentioned the plan's currently underfunded. The plan is going to evolve from an underfunded state to a fully funded state by one of two ways: funding into the program and investment performance of those funds. And so the question then becomes, well, what's the right mix of funding in versus investments? How much do you want to rely on your investments? How much do you want to rely on your funding? If your funding is healthy, perhaps you can take your foot off the gas ever so slightly. And so that's the potential direction of travel that we'll examine. In terms of the portfolio analysis, I mentioned well-diversified portfolio, 8.16% expected return for the fund, quite healthy versus the actuarial assumed interest rate of 6%. So a nice surplus of expected return. And over the 30-year time frame, 81% chance of surpassing the hurdle. So a strong, healthy financial state today and going forward. I mentioned that the asset liability projection analysis shows full funding by 2031 in the expected case. Of course, that's dependent on what the markets give us. That's in the expected case. Markets could give us more or less than the expectation. And so we examined not just the central trend, but also what do those upside and downside tails look like. And of course, with the contributions creating those buffers, that'll be important because it adds an extra layer of safety to the overall finances of the fund. All right, so that's at a very high level the state of things. Now we're going to spend much of the next 20 or so minutes diving into numbers. I'm going to turn it over to John, who's going to start talking about the contribution policy and what we studied, and then ultimately what we found.
Thanks, Phil. So as Phil mentioned, the goal of this exercise is to show the integration between the assets and the liabilities and how it's going to evolve over time. One of the key components of that analysis is understanding the current contribution policy and how those contributions are going to change over the various scenarios that we end up running. Phil noted the contribution policy for Michigan is unique from what we see for other plans. And what we wanted to do is kind of hone in on a couple of those nuances that are unique to Michigan, because what this is going to do is it's going to allow us to fast forward to the results and have those results kind of tied to the central themes that we're going to touch on right now. So three unique things that we see in terms of the contribution policy for Michigan. First being that there's a floor provision for the public school plan. So essentially, contributions are not going to go below a certain threshold regardless of the investment environment. So if there are great investment returns, contribution is going to stay level from what it was last year. It's kind of different from what we see for a typical plan where the asset performance is going to then dictate what the resulting contribution will be in the future. Good asset returns generally lead to lower contributions in the future and vice versa. What we're going to see is that contributions in Michigan's case are going to remain fairly level, and the floor provision is going to be one of the reasons why. Second item I want to touch on is the closed amortization period. So just as a refresher, contributions are essentially calculated in two fashions: new benefit accruals as well as paying off of the unfunded liability or the amortization of that unfunded liability. Michigan's policy is to specify a point in time at which that policy will be fully funded. What that means is, regardless of the economic environment leading up to that period, the assumption is made that contributions are going to be made to ultimately take the plan to that fully funded state. So what we see when we get forward in our contribution analysis is that there's going to be some very large tail outcomes. They're going to be driven by this amortization policy. And then the last item that we wanted to touch on is banking excess returns. As Phil noted, the expectation for the current policy is a return of 8%. The actuarial return assumption is 6%. So that 2% delta is essentially offsetting. It's going to take the plan to full funding faster than the amortization period alone would indicate. So those are three aspects of the contribution policy that we'll then see play out into the asset liability results that will soon follow. And then just to kind of line up the executive summary, we ended up studying a range of different portfolios, kind of a spectrum of high risk, low risk, and everything in between. And what we ultimately landed on that we wanted to hone in on are the current policy, so the 87.5%, so the first column on slide 9, as well as the alternative policy, the 85% return seeking portfolio. What this policy is doing is taking 2.5% from real return and opportunistic and adding it to fixed income, as we had touched on earlier. The impact of this towards the bottom half of the table, we're going to see a decrease in expected return of about 12 basis points. We're going to see a much larger decrease in volatility to the tune of about 34 basis points. The resulting impact is going to be a similar Sharpe ratio, similar efficiency for the alternative portfolio. But the alternative portfolio is going to have a better downside impact. It's going to still have a very good likelihood of meeting the actuarial return assumption of 6%, and it's going to reduce the illiquid assets in the plan as we're bracing for the increase in net outflows over the coming 10, 15, 20 years. So those are the highlights from the executive summary, where I'll get into a lot more analysis that supports the topics that we have talked about, but I will pause here if there are any questions before we move on.
I see there is a 2% increase in the upper end of the range for PE. Is that just to give the team more flexibility, difficulty?
Yes, it is. Just to bring the current allocation more in line with policy.
I had a quick question on when you use the term fully funded.
Sure.
Is that actuarially fully funded, or does that even consider any kind of termination costs, or is that above and beyond?
So for our definition of fully funded, we're looking at a straight market value of assets relative to the actuarial liabilities. So we're not looking at the smooth value whereby contributions would be determined based off of. So fully funded is when the market value of assets is going to equal the liability. And theoretically, when that time comes, it would be kind of a potential resetting of some of the other assumptions to make sure that that fully funded state gets maintained.
Thank you. One other quick question is the prior study that you performed, if you went back and looked at that compared to actual results, were there any learnings from that, any differences? I know these studies are, don't certainly predict what's going to happen, but were we close?
Well, a couple interesting things from the last study. So what we did not talk about yet was the dedicated gains policy that was put in place for all the pension plans to essentially reduce the expected return on the actuarial side systematically as excess gains have been had on the asset side. So when we did the last study, there was a lot of discussion about how that policy would evolve. Things along the lines of, is there a certain floor that we should have the actuarial discount rate go down to? At the time, we were at 8%. And in looking ahead, it was, well, that's kind of a decision for way out into the future. We don't really have to worry about that too soon. Lo and behold, over the last couple of years, we've reduced from 8% all the way down to the floor that we assumed the last study of 6%. So the dedicated gains policy definitely advanced in a similar fashion that we had kind of analyzed the last time. So that was one of the key things that we have seen. But other than that, the same themes hold. What we're going to find is that the contribution policy in and of itself is really going to lead the plan to full funding, along with the excess returns over and above the actuarial rate of return. So a lot of similar themes, different underlying numbers behind it. Sure.
Not sure if now is the time for the question around, but that floor is still appropriate. I think we talked about that later. That 6% senior rate of return. Certainly, there's a lot of public policy conversation around that. Curious throughout the presentation to get your feedback around where we ought to be, whether that's still the next several years the place.
So I'll split that up. Where you ought to be would probably be more specific to the wants and needs of Michigan. What we have on the screen is where you are relative to peers, and the 6% is 6% is at the low end of the spectrum relative to other public plans. So from that standpoint, I think that what we're going to find over the coming years is that other entities are going to be catching up to Michigan, moving in this direction. Whether that indicates there's anything that needs to be done about dropping it even further, that becomes kind of another debate in terms of cost risk analysis. So, because what we studied the last time, which was interesting, is that the dedicated gains policy works great when you achieve excess returns right out of the gate, which is essentially what happened when the policy went into play. When there are negative events, it can have counterintuitive results of increasing contributions into the future. So the fact that the dedicated gains policy is exhausted, we've essentially kind of tabled that one concern. To the extent that we reintroduce it, that could be something else in the future that should be considered in that cost-benefit analysis.
If you shoot over to the corporate world, maybe you can comment on that. There's really two different accounting systems. You're probably familiar, but that's the great academic debate. You're probably familiar with. But
yeah, I was just saying, what the dedicated gains policy was doing is essentially moving, in this case, the public sector discount rate in line with what corporate plans have been doing over the past few years, and recognizing that 8% that we had a decade ago was probably a little bit too high, and how do we get down? And then the policy, because of the performance over the last 5 or so years, really kind of, we can see from fiscal year ending 2015, it was 8% all the way down to 6%. We've seen plans that move in, it's called dribs and drabs, as low as 5 to 10 basis points at a time, or as high as 25 to 50. This is by far the biggest decrease in that period of time that we've seen relative to other years. So what I'd like to do is move us into the analysis section, so page 11 of the presentation. And what we're going to focus on today is predominantly the public school employees retirement system, specifically the pension. Why are we focusing on this plan specifically? Because it represents the lion's share of both the assets and liabilities. As we started to talk about, we studied a range of different portfolios as part of this analysis. On the top half of the page, we're looking at our risk reward spectrum. There's a lot of data points. Essentially, the way to read this exhibit is the vertical axis is our expected return. Horizontal axis is our expected volatility of the portfolio. What that red line represents is the pro rata adjustment of the current policy, dialing up the risk all the way up to 100% return seeking, dialing down the risk all the way to zero, but we kind of showed down to about 70%. And then there's a smattering of different portfolios that are also noted. What we find are, in terms of Aon's best thinking, which we noted as our model portfolios, which kind of range from liquid, strictly public market access to complex with healthy allocations to illiquids, that the current policy has a superior return and lies above most of those model portfolios that Aon put forward as a starting point for portfolio discussion. What we're also going to focus on is that purple square, the alternative policy, which is essentially just dialing down the risk, as we had touched on, the 2.5% moving from real return opportunistic into fixed income. Bottom right hand is a more concise table of the expected return, volatility, and Sharpe ratio for all the points that we're looking at. But essentially, the focus that we're going to have today is on that current policy as well as the alternative policy, so that 8.16 versus the 8.04 returns. As we're looking at those return expectations, those are our median return expectations, and there's essentially going to be a range of outcomes around those. What we do on slide 14 is illustrate what that range of outcomes could be as part of our capital market assumptions. So what we're highlighting in the center of the page is the alternative policy and the current policy, and then we bracket that with a less risky portfolio, the 70%, as well as a more risky portfolio, 90%, so that we can see kind of the distribution as we dial up and down risk. So looking at the current policy, the central expectation, or that black diamond, is the 8.16, but there's a range of outcomes around that. The blue bar is going to represent the 25th to 75th percentile outcome, with the black lines representing the 5th to 95th percentile outcome. Orange line on this page represents the 6% actuarial return assumption, and what we're going to see is that the outcomes of the policy over a 30-year period are expected to significantly outweigh the 6% actuarial return policy, so that we see the entirety of that blue bar lie above the orange line. So there's roughly, under the current policy, an 81% chance that the cumulative 30-year return is going to exceed 6%. That number reduces to 80%, so still very high conviction under the alternative policy. So that's looking at the portfolios by themselves. What we then look at is how are these portfolios going to impact the funded ratio of the plan. What we're looking at on slide 15 is a short-term funded ratio impact. When we're looking at funded ratio impact over a one-year time horizon, what we're really focusing on is the investment implication on the funded ratio itself. Contributions are not going to be impacted based off of the short time horizon, so this is purely how the investments are going to implicate the funded ratio. Again, still using the same policies, focusing on the alternative and the current. What we're seeing is that over a one-year time horizon, we would expect that the funded ratio is going to increase to just north of 67%. Again, the range of outcomes around that, going as high as 80%, dropping as low as 50%. And then we can see we get wider distributions as we dial up risk, narrower distributions as we dial down risk. So this is looking at a short-term picture, which is, again, going to just focus on the investment implications. When we take a look at the longer term on slide 16, this is where we then layer on the contribution impact to those funded ratio calculations. And what we're going to see is that ultimately, again, focusing on the range of 70 all the way to 90% return seeking, plan is expected in our median expectation, which is that dashed black line, to get to full funding in this case, or 100%, by fiscal year ending 2031. And we can see how each different policy is going to impact the time at which we hit full funding. For the alternative policy, we're assuming that full funding is going to occur fiscal year ending 2032. So very, very similar, especially given that we're only talking about a 12 basis points differential for that alternative policy. What we can then see is that looking at this analysis, we're expected to, under the current policy, reach a funded ratio in our median expectation of 165%. at the end of a 20-year period. That reduces to 161% for the alternative policy. So going back to what Phil said, the policy is designed to get to full funding and then advance well beyond that. This might be an opportunity to dial back risk a little bit as we start to expect to hit those funding thresholds. Interesting note that you will see at the bottom line of our display is our fifth percentile, or our worst case expectations. They are similar across all the policies. And at first case, that might seem counterintuitive of, we're dialing up and down risk. How does that make the funded ratio the same? The answer is going to be how the contributions are impacting these calculations. And we'll see that on slide 17. Again, looking at 70% to 90%, what we're going to see is our central expectation across each of these policies is that dashed black line is going to reach about $4 billion in total contributions. This is employee plus employer, and essentially maintain that level and drop down once the plan reaches full funding. So each of these lines that then drop down to kind of a floor level is going to indicate the time at which that scenario is going to achieve full funding. So in our expected case, we're seeing contributions just surpass $4 billion, kind of stay relatively flat based off of that floor provision that we had talked about in the contribution policy, and then ultimately drop down to just funding the normal cost or benefit accruals once the plan achieves full funding. In our adverse scenarios, or the green lines, we're going to see that the contributions are going to be increasing over time. And they're going to be increasing in part due to that closed amortization aspect of the contribution policy. As that policy winds down, contributions will be made to the plan in order to achieve full funding, and we can see the levels at which those contributions may be as part of this analysis. At 70% return seeking, that contribution results in about $16 billion, all the way up to almost $18 billion in that 90% return seeking allocation. So contribution policy is going to be directly linked to how the funded ratio projections are going to play themselves out. Slide 18 kind of just summarizes a lot of the results that we walked through, placing special emphasis on the current policy and the alternative policy. What we're highlighting here are on the left side columns, the portfolio metrics, the 30-year expected return, volatility, Sharpe ratio, as well as our 2 standard deviation 1-year downside return. So alternative policy has a 12 basis point give up in expected return, reduces volatility by about 34 basis points, keeps a similar Sharpe ratio, has a better downside expected return. And then we can see what the financial metrics are in terms of present value contributions and our ending funded ratio, the 165 versus the 161 that we had touched on earlier. And then just to kind of wrap up the analysis section, we had touched at the outset and setting the groundwork for this discussion that net outflow is going to be increasing over time. And what we show on this slide is how that net outflow is expected to evolve based off of the information that we received from the plan actuary GRS. So the way that this exhibit is structured is that this is looking at the aggregate of all of Michigan's plans, the blue being the aggregate of the pension plans, the yellow being the aggregate of the OPEB plans. And that over time, what we're going to see is that the net outflow is going to be increasing, and it's going to be increasing at such time that the plan is going to get closer and closer to full funding. Once it hits full funding, contributions are going to decline, which is going to perpetuate the net outflows. And that's what we ultimately see happening as we go about 10 to 15 years out into the future. So that is kind of our summary of a lot of the analysis that underlied some of the opening remarks that were made. So before we kind of move to wrapping up with our conclusions, happy to pause and take questions here, or we can wait until the very end.
Questions?
So let me turn it over to Phil for summary and conclusions.
All right, excellent. So we started with the bottom line on top, and we're going to conclude with the bottom line on bottom. So the messages that I shared right at the top. Lots of analysis, lots of number crunching to kind of derive these three key themes and kind of the foremost themes from the analysis. Starting with the portfolio mix, the mix of return seeking versus risk reducing assets. You see a plan today that's underfunded, but is projected to have a healthy trajectory going forward, projected to get to a fully funded state by 2031, and then move higher thereafter, and in fact, well higher thereafter, up to 160+% funded ratio, and that ultimately would be overshooting the mark by a good amount. So the question then becomes, well, if we start paring back, how might we do that? Let's consider that. You see the portfolio is well constructed. I mean, John summarized it well at the top in terms of well constructed and well performing portfolio. The portfolio is so well performing that the funding ratio is expected to go well north of 100%. So really, it's a question of taking the foot off the gas just a little bit. So that's what we studied. That's what we considered lower risk portfolios as part of this discussion. The 85% alternative portfolio. In terms of liquidity, you saw the liquidity profile. We're expecting net outflows. Frankly, it's a good thing. That you're funding up to 100% funded, and then the contributions fall off. It's when those contributions fall off that you start having more net outflows. You're paying out more benefit payments than you're taking in contributions, and that's because you've fully funded the plan at that point. And so, but the net outflows will increase over time, and that means a greater need for liquidity at some point down the road, and the evolution towards that end. And so for that reason, it makes sense to increase the liquidity profile of the fund today and into the future. And then finally, the funding interaction. As John mentioned, the funding of the program is unique. It's unique and it's conservative. It effectively locks you into those $4 billion annual funding amounts until the plan's fully funded, and then it'll fall off. And that adds a bit of conservatism. It stabilizes the numbers, both in terms of predictable contributions, but also in terms of predictable funding ratio advancement over the next decade or so. And so the funding policy is effectively affords the state of Michigan some high probability of success in terms of funded ratio. All right, so with that, that's the main messages, those 3 points. With that, happy to take questions.
Was that long ago that I think it's 2038 was the assumed funded status. And so our investment returns, success of that has been able to bring that closer to today. Can you talk a little bit about what the implications, what it means to be fully funded? So, intuitively, but perhaps Director Harkins would like to know, how does that impact the state's budget? In other words, does the state all of a sudden have to stop contributing billions each year because now the pension fund is going to be contributing? That would have a dramatic positive impact on the state.
And I'll start and then feel free. So it's a great question because things will look different when the plan's 100+% funded than it does today, because your contribution is really the sum of two pieces. It's the cost of new benefits to your people every year. They earn, 1 more year of service means their pension benefit is bigger, and there's present value cost of that, the added benefits that people earn with an additional year of service. And that's called the normal cost. There's an additional component that's the pay down of any shortfall. And today you have a shortfall. And so that portion of the contribution is significant because you're effectively paying down that shortfall over a, call it 10 to 15 year period. And so it's that second component which effectively goes away when the plan becomes fully funded. And so that's why you saw John's contribution projections kind of fall off. They fell off expected 2031. In the best of times, it falls off even sooner because you're no longer amortizing those shortfalls. Those shortfalls go away and you're left with just the normal cost. So that's that's quite a healthy state, right? To be in the position where you're fully funded, because then it's not so much making up for a shortfall. It's just once you've gotten to a fully funded state, you want to maximize your chances of being there, staying there, right? You got there, maximize your chances of staying there. And so adding stability, adding liquidity, all those things in that regard.
And then just to add to what Phil said, so right now, what I think implications would need to consider is that the contribution policy today is designed to get to full funding. That may not be the contribution policy when you're at full funding. By the letter of the law and how it's stated, once you hit full funding, you would immediately recognize any losses with contributions that next year versus kind of smooth them out over time. So there could be some rationale for keeping that policy, but that would be something that you would want to discuss. The other would be when you hit full funding, the reason that our funded ratio is going up into the 160s is because at that point assets are returning 8%, liabilities are returning 6%. They're just going to be building that surplus over time. There's a rationale to building that surplus now to get to full funding. But when you're at full funding, then it becomes, is your goal to grow this funded ratio even further than 100? And if it's not, then maybe at that point, then we start to think about dialing back risk.
It seems that your changes that you're recommending are relatively modest. I'm kind of curious to see, how you see other peer systems making changes. Are they similar in magnitude to what you're recommending here, and more or less?
I would say that one, the modesty of the allocation changes are a byproduct of how often we look at this. So if we look at it as we're touching on, we typically see clients look at AL studies every 3 to 5 years. If we look at it every 5 years, chances are we might be a little bit more than 2.5%. Because we're looking at it every 2 years, those moves are going to be a little bit more incremental. And Phil can opine as well, but I find that clients where we do consistent asset liability studies, we're more kind of tweaking around the edges versus doing any sort of wholesale changes. I think there would need to be something that would be fundamentally changed in the plan when we're looking at an asset liability study. So, for instance, if we get back together in 2 years and the plan is at full funding, we might be having a conversation where we're going to be thinking about something that might be more than marginal. But that's usually one of those good problems.
Markets can't wait for that. That's the best day.
That's that. I'll bring cake.
But I would say that the materiality of the moves that we're talking about is in line with what a lot of other public plans are doing, changing their incentives. Great.
Any other questions?
As you, John in particular, as you are doing this with other publics, are there any sort of public policy concerns that you are aware of that we should be concerned of as well?
Public policy concerns in terms of how the contributions impact things like the budgets or?
Sure. I think we've been very fortunate to have in the state, we've made some pretty sizable policy changes to get us to this point. We've been able to work with the legislature now over many years to ensure that we continue these funding strategies. There are billions of dollars appropriated annually to do that. And that can't really be taken for granted. I look at the charts on page 17, I think I'm kind of reference a little bit of that delta between when we are paying off and we're dropping $3.5 billion essentially in terms of
right.
We work really hard to make sure that our legislative partners understand the value of education. So that's a risk for us in terms of that public policy piece. But I feel like we understand that well here. Are there other examples around the country where there are some different, perhaps either political or public policy conversations that are happening, we're not discussing yet, or that we should be aware of.
So I think that there could be options on both ends of the spectrum. So what I find informative about these types of analyses is communicating that the policies in place, specifically for Michigan, if I look on slide 17, based on the policies that are in place, there could be a contribution that's needed upwards of $17 billion at some point in the future. One of the reasons, and Phil touched on it, about why we conduct these types of studies is that a lot of times when we look at actuarial valuations, everything is assuming a smooth ride until we get to full funding. It's assuming that we're going to hit our expected returns every year, and we see contributions not really too much or stay in a more intuitive fashion. What we see when we do these stochastic projections is kind of test that range of outcomes of what could happen based off of the policies that are in place. So the thing that I like making sure that we communicate is that there's a potential that there could be significant contribution to the tune of $17 billion needed in the future. So it highlights where policies that have worked to date might not necessarily be a set and forget it type strategy. On the flip side, in terms of your example of contributions going down, I kind of look at that like, you think about like health insurance premiums or things like that. You don't necessarily want to get whipsawed with those of, you had great experience, let's dramatically reduce contributions. Oh, we had bad experience, let's ratchet them back up. So those would be conversations that would need to probably need to be refined to come up with a different type of contribution policy. We have some clients that adopt a lot of these principles in terms of building up buffers through different means. So you could almost set a floor for what contributions are going to be at some point in the future when you reassess kind of where the plans are at that point. But Nebraska is an example that comes to mind of a plan that is benefiting from that type of strategy and finds themselves in like a fairly highly funded position.
Yeah, I think it's a great question. Ultimately the plan's underfunded now, and the path to full funding is going to be reliant on a combination of funding and investment performance, right? And so your funding is diligent, and your investment performance has been good, great. And so, the combination of those two things is what we would project takes you to that fully funded state. Now, that's, diligent funding, that's the antithesis of many public funds, over the last, let's say, 2 decades, right? And so I think increasingly they've become more diligent in terms of funding. But if you look back 20 years ago, funding was not the same. And so I think it's an important part of how you get from an underfunded to a fully funded state. And so to forego one of those two tools is going to really challenge the ultimate outcome, right? Because if you're reliant on the investments alone, boy, that puts a lot of strain on the investments, right? There's a lot of stress on the investments. And the converse is true. The more you fund, the less you strain or less you stress or less you rely on the investments as your sole way to get to a fully funded state. So it's in that way, it's quite diligent and good and healthy. But John's point about the tail events, that's important because, let's say your amortization, you're going to be fully funded by the design of your contribution policy. You're going to be fully funded by 2035. And it's a declining amortization period. So 15 years, 14 years, 13 years. What happens if in 2034, almost fully funded, and the bottom drops out? You have to, by the design of your funding policy, you have to make all of that up in the 1-year period. That's why you get that green tail. That's the event. Now, it's not likely, but it's possible. So we want to be aware of that because the numbers get kind of noisy in the 2030s. And it's because of the design of the funding policy. So you may be well overfunded at that point where it's not really a concern, right? But that is a possibility. Let's be aware of that instance. But by and large, what's most likely to happen is the numbers stay pretty stable around where they are now, and then they fall off. And knock on wood, let's hope for that case, which would be a fantastic result. And at that point, taking your foot off the gas a little bit. You don't need all that gas. You don't need a 160% funded plan, assuming that everything is as it is today. And so maybe taking off the gas a little bit, and not necessarily all at once. It can be a very gradual thing. And be revisiting this every couple of years and just making sure that we're on track.
By taking your foot off the gas, what you're saying is you're taking risk off the table. So you're less likely to have a lot of fallout. The global world has major issues, we still have a relatively conservative portfolio. So we can weather it out and not have that 17 billion plus.
Exactly.
On the worst end of the spectrum, we're nowhere near. You have a low funded plan. This is from an investment perspective. And you have a state or employer that can't make full contributions. So you have maybe high net outflows, but you need a high expected return. You can't really go into private equity because it's all locked up because you get in this really kind of concentrated, hoping public equities work out for you. And of course, in any 1 or 3 year period, public equities can really swing in volatility. And so CIOs that have to run a non-funded plan about contributions, it's like they can't set a steady investment policy in private equity because it's all tied up. So that becomes kind of the downward spiral effect from my perspective, or at least a greater chance of downward spiral.
That's right. We've seen that. Usually we find that there's room for additional illiquidity premium capture with private assets. Usually we find that's the case, but there are times that we found that there's too much illiquid where you can't weather the storm in a downturn, and the portfolio becomes swamped with illiquid assets. That becomes a problem in terms of the ongoing operations. Absolutely, and you want to be aware of that going, before it happens.
Good discussion. Hearing no additional questions, I want to thank our presenters for all of your work that led us up to these recommendations, and also for your presentation being here with us to present to us today. It's very informative. Thank you.
So agree with one piece of housekeeping here. So this report today is an executive summary of a full report. It's 160-some pages. So it's a very dense document. That document will be posted on the website. We also, Aon also creates kind of an in-between memo, they call it memo, that will summarize the executive, the full report. So we will place both of those on the website shortly. The discussion today was primarily focused on the NPSER's pension. The same exercise will be done across all the OPEBs and all the pension plans, and those reports will be published on the site in the next few months. So I just wanted to put that out there that this was very focused, but we'll have a lot more information to share, but it will rhyme with what was discussed today.
We look forward to it, and certainly understand this is a big kahuna, so my
Yes.
that's mine.
Yes.
On it really first. Do you mind just keep chatting and talk us through the resolution?
That wasn't prepared.
Oh, that my note says you're going to talk about
I'm going
it.
to
but
talk
I'm
about,
happy
okay,
to talk
yeah,
about
no,
it.
I'm happy to talk about it. Okay. So the resolution you have in front of you today is a small change to the strategic asset allocation. And what the strategic asset allocation does is it helps to lay out the plan for how we are going to go about doing our job, your investments, right? So what was mentioned today and hopefully was appreciated, we have a good plan in place today. looking towards the future, liquidity is on our mind. And a data point that wasn't necessarily, it was shared, but I just want to bring home a little bit. Over the next 10 years, we're estimating, or it is estimated, that the plan will pay out net contributions approximately $40 billion. So we have to come up with $40 billion over the next 10 years. Illiquid markets, they pay when they pay, right? So our thinking is, and maybe Dina's your earlier comment, that if the markets are providing us a little bit better opportunities in public more liquid investments, this may be an opportunity for us to lean into those types of investments, recognizing it's going to take us a long time to make changes from private to public, recognizing we have a good plan as it is, recognizing that we have to take risk in order for all this math to work out. So it is an incremental change moving from RRO to fixed income over the next few years, and we'll resume this discussion in the next 2 or 3 years.
Sounds great. Thank you. So before us is a resolution 2022-2. A very succinct resolution. I want to commend Mr. Borquist's legal work as usual. Very nice resolution, which provides direction to the staff, as Greg just mentioned, to adopt allocation targets that we just spent time talking about. Is there a motion to approve that resolution as presented? Thank you, Reggie. All those in favor, are we going to do roll call for this? Oh, I'm sorry, Janet, can you do roll call? Yeah, please.
Chairman Treasurer Rachel Eubank,
Yes.
Christina Richard,
Yes.
Mr. Reggie Sanders,
Yes.
and Mr. Chris Harkins.
Yes.
Thank you.
All right, the resolution has been adopted. So congratulations to all of your hard work here. We do have investment reports that are just normally we have, kind of pick out some to chat about today, given the nature of this conversation. I think we're skipping. They're still here for you to review. And Greg, we still have a little time if you'd like to do a market review.
Sure. Let's.
I keep putting you on the spot today. You don't need to, but again, my notes are telling me that I still like to.
So happy to do a market review. Thank you. Unfortunately, this is ancient history, right? The world was much different at the end of June than it is today. At the end of June, although we were getting repricing in the fixed income market today, so yesterday the Fed had its policy meeting, raised short-term interest rates again by 7 basis points. They clearly communicated that they are taking inflation very seriously, and the terminal rate continues to move higher. The market returns, when you look at what's driving investment returns, equities, specifically within domestic equities, the returns on equities are at highs. They continue to be at highs. Profit margins on the companies, the largest companies in the United States, publicly traded companies, are at all-time highs. Now, there's some reasons there. For one, they're fantastic companies. For two, they're near monopolistic. They're asset light, meaning they're more service oriented rather than industrial machines, things like that. And so corporations have taken steps over the past 20 years to outsource a lot of their higher cost, lower returning centers. And so interest rates are lower, tax rates are lower. So there's a lot of reasons for why the profit margins are higher. All that means is that the returns on equity, again, are pretty good. Now you're talking about the price you pay to get access. And that's what's happened over the past few months. The valuations in the public markets have corrected. So they come down. The fundamentals are still pretty supportive. Right? Now the future fundamentals that we're talking about, the Fed, we're talking about trying to get a handle on inflation, talking about perhaps slowing down the economy, that will likely lead to slower economic growth, potentially a economic recession. Clearly, the fixed income market is signaling some trouble, potential trouble, right? So that typically is indifferent to the valuations of the stock market. They are very sensitive to the fundamentals that drive the stock market, right? So forecasting perhaps a little bit here, the Fed has green lights to continue to raise interest rates up until the point where it starts to hit the economy. People start losing their jobs. People start, the profits are correcting faster than what is desirable. And so those are things. In addition, there's a big in the cost of energy. There's a global concern about the sourcing of energy due to the Russia-Ukraine conflict. And so that is being priced in particular. Inflation continues to run high. In June, the inflation reading was 9.1%. It is what I think freaked out markets last month. It seems to be stickier. It seems to be more persistent than what Fed had initially communicated. It's certainly more sticky than what I was, I guess, hoping for past 12 months. So, yeah, so that's, I guess, a review of the capital markets. They're on stock prices going lower. The lag in private markets, we'll see where it takes us. That's a world tour. We can answer any questions. I don't know if you have any insights. Like I'm interested in insights, taking questions, but I'll entertain both.
I have a question on, any thoughts on strong dollar?
We do talk about the dollar, chiming on this, but it is creating problems globally. Prices in many commodities are priced in dollars, which again I mentioned in the United States we're a consumer, we're an importer, so a strong dollar can be helpful in addressing inflation, but all that means is that we're exporting inflation, which causes problems outside the United States, but in a global economy, that's not sustainable. So it's, in my opinion, and again, I don't have all the answers, but in my opinion, it's a symptom of a problem rather than a problem in and of itself. Yeah, because I'm curious.
It's, it's such a premium right now too, like the yen, so we're watching that.
Yes, I know. Anecdotally, my daughter went to a study abroad, and we got her some currency for some spending money. And, we got $50 in pounds and euros or whatever. It's like, I don't really want to convert that right now. So, I don't, So that's my bet. That's my personal bet. I've got $50 ready. I'm appreciating it over the next few years.
It's a great time to travel internationally, right? The dollar goes a lot further, but it's very the same, those that we rely on to come here and travel to the U.S., are not spending less because their seats worth less.
It starts to shift things. I mean, China's starting to use, they're going to be buying oil from Russia at a lower price. So as Europe doesn't buy the oil's still going to get sold. It's going to Russia and maybe India where they have to feed populations and provide for them. So there's a lot of things in play that's hard to the colored marks know about the future. So they're pricing some of those on the margins. The dollar's still the world's currency, will be for our lifetime, but there are currencies now that are being paid for, energy's being paid for, not in dollars in some of these instances. That probably won't go back. And so that's kind of an interesting thought. And there's a lot of stuff in play. I think, China processes 60% different, mining things that come out of the ground. We don't like for environmental reasons, but a lot of that's in Russia, and China processes a lot of that. So it's a pretty complex situation that we have going on right now with the Dow, how that evolves. Need some wise leadership at all different levels. There's a lot of stuff in flux right now.
Such an amazingly interconnected global economy. I was reading this morning how, I mentioned China is buying commodities from Russia, right? Cheaply. Russia doesn't have any place to sell them to. But China now, in the natural gas arena, LNG in particular, has more than they need. So what are they doing? They're selling it. The importers actually exporting something they didn't create themselves, and that brings prices down globally too. So China can't get away with it. Russia can't get away with this, but that's going to push Russia's prices even lower. They're going to sell to. And the world interplay with China is changing dramatically. It was about a decade ago that there was a 40 times reduction in labor. If you're a company, you want to produce your product in China, labor was 40 times cheaper. Now it's only 4 times cheaper. That's a dramatic difference. That's leading to more onshoring and other policy decisions. So times are changing.
Absolutely true. Okay. Janet, would you like to turn the videos back on so we can see if any member of the public wishes to address the board? So we've reached the time for public comment. If any member of the public wishes to address the board, now is your opportunity to do so. I just ask that you identify yourself before you start speaking, and please limit your comments to 2 minutes. As we look to open up public comment, please note if you've dialed in with your cell phone, it is *6 to take yourself on and off of mute. If you're in the app, the mute button is the microphone in the upper right-hand corner. So now, does any member of the public wish to address the board? Yes, Ms. Pollock, please go ahead with your comment.
Yes, I'd like to know if the resolution you passed applies to all investments or just those designated for the MIPSers.
Thank you for that question. The resolution is designated for MIPSers. And I'm just kind of reviewing here to see if we said that. I wonder if that kind of clarity would be useful. Greg, do you think? I mean, do you think you've seen these in advance? Are they drastically different?
The change to strategic asset allocation was intended to be across all components of the plans.
So
I don't know if it was explicit.
Okay, so when you mentioned the reports that we're beginning on other systems that we have yet to discuss, would that change this resolution?
There's a low likelihood. We're anticipating that because of past experience of the asset liability studies. It was mentioned earlier that one was performed 2 weeks ago. These plans prime inserts.
Okay.
Right? So it is our expectation that this strategic asset allocation that was adopted today, that was intended to cover all of the plans, is appropriate for all of the plans.
Okay. So even though it was, this is a great public comment, thank you. Even though this resolution was guided specifically by the analysis of the MIPSers component of the plan, it does apply to all plans. And if any of those additional analyses demonstrate need to revisit this resolution, we will make sure to do that. But it sounds like it is unlikely to do so. Thank you. Any other public comment? Anyone in the room? Okay, seeing none and hearing none. Thank you everyone for your participation today. Our next meeting is scheduled for December the 8th. I will actually not be here again for that meeting, but you can have a wonderful radio voice again of Director Harkin to guide you through that meeting. Is there any additional business from the board to talk about today? And if not, is there a motion to adjourn? Motion to, and a support? Thank you so much. All those in favor signify by saying aye. Aye. Any opposed? Thanks, adjourned. Thank you. Thank you. No, I know.
20, 30 times. I know. It's too.